Okay, so when you hear the name Broadcom, what's the first thing that comes to mind? For most of us, it's chips, right? So how on earth did a chip maker build a nearly $2 trillion empire? Well, the secret isn't just AI. It's a really powerful strategy they have, a dual-engine flywheel that basically combines hardware and software into one unstoppable machine. Let's break it down.
Here's how we're going to do it. First, we'll deconstruct that dual-engine flywheel. Then, we'll get into the crazy 93% margin machine that powers it, explore their ultimate AI moat, and see the financial powerhouse it's become. After that, we'll look at what the market thinks, and then wrap it up with the StoxCompare verdict.
All right, first up, the dual-engine flywheel. To really get Broadcom today, you have to understand this core idea. It's not one business, it's two, and they work together perfectly. So here are the two sides of the company. You've got engine number one, which is their semiconductor solutions. This is the classic Broadcom we all know, making those high-end custom AI chips and networking gear. But then you have engine number two, infrastructure software. This is a division they've built up through huge acquisitions like VMware and Symantec. And the synergy, the way these two work together, it's driven an incredible 167% revenue growth in just 5 years.
But revenue is only half the story. Now we get to the really wild part, what we're calling the 93% margin machine. This is where we see how that software engine isn't just growing, it is an absolute cash printer.
Around 93%, yeah, that is the gross margin on their infrastructure software business. Just let that sink in for a second. For every single dollar of software revenue they bring in, 93 cents is gross profit. This isn't just good, it's an almost unbelievably efficient financial engine. This right here, this is the fuel for the entire flywheel.
So how in the world did they do that? Well, they have a very clear playbook. After they buy a company, say like VMware, they apply this margin funnel. It's ruthless. They cut all the bloat, restructure the costs, and shift the entire focus to high-value subscription models. And the result? A business that is literally engineered to just pump out enormous amounts of cash.
Okay, so here's the crucial question. What do they do with all that cash? Well, that brings us to Section 3, the ultimate AI moat. They poured the profits from that software cash printer directly into funding their super defensible and, surprisingly, asset-light AI hardware business.
And this is what makes their AI strategy so unique. Instead of just selling general-purpose GPUs off the shelf like an NVIDIA, Broadcom specializes in what's called custom silicon, or ASICs. These are bespoke circuits designed for one specific customer for one specific task. The upside? They're hyper-efficient, and, this is key, they create extreme customer lock-in. The switching costs are incredibly high.
And the best example of this is their crown jewel, the partnership with Google on their TPUs. Broadcom actually co-designs Google's custom tensor processing units. Now, this isn't a one-off sale. This is a deep partnership that's locked in all the way through 2031. That means they have a predictable, defensive stream of AI revenue guaranteed for years and years to come.
Okay, so let's recap. We have a software business that prints cash, which then funds a custom hardware business that builds a huge moat. So when that flywheel is spinning at full speed, what's the output? A true financial powerhouse.
How about an estimated $26.91 billion in free cash flow for 2025? That's the actual cash left over after running the entire business. It's a massive number that just hammers home that cash printer idea, and it's the ultimate fuel for rewarding their shareholders.
And believe me, they are absolutely committed to rewarding shareholders. They're allocating all that cash through a really healthy mix of growing dividends and share buybacks. The key thing to see here is that it's sustainable. The dividend only uses up about 41% of their free cash flow, which leaves them plenty of dry powder for whatever comes next.
So the strategy sounds impressive on paper, right? But the real proof is in the performance. That takes us to market validation. How have investors actually reacted to this whole dual-engine model?
We'll take a look at this. Over the last 5 years, Broadcom stock has soared over 772%. In that same period, the tech-heavy NASDAQ, up just about 75%. That's not just outperformance. That's the market giving this strategy a massive stamp of approval, pricing in both the power of VMware software revenue and that explosive AI hardware business.
All right, let's bring it all together now with the StoxCompare verdict, where we'll balance that really compelling bull case against some of the potential risks you need to know about.
The bull case is pretty clear and powerful, right?
You've got those unmatched 93% software margins acting as a cash printer, an asset-light AI model that generates massive free cash flow, and a super secure growing dividend. But on the other side, the bear risks are also pretty clear. There's heavy customer concentration, a huge reliance on that Google partnership. And there's also the risk that if the lower margin AI hardware business grows faster than the software business, it could start to drag down the overall margin profile of the company.
So this all leads us to the final question. We've seen the software engine, we've seen the custom AI moat that it funds, and the incredible financial results it all produces. So with its dual engine flywheel now spinning at full speed, is it possible that Broadcom is the most defensible giant in the entire AI revolution? So that's our breakdown of the Broadcom flywheel. For more deep dives like this, where we unpack the real strategies behind the market's biggest players, make sure you subscribe to StoxCompare. Thanks for tuning in.